You know, they always say debt can be super dangerous if it gets out of control, right? But what if the real danger is when it becomes too essential? In 2008, the system nearly collapsed because banks held too much bad debt. Today, those same institutions are building strategies around something far more unstable, the assumption that sovereign debt will never stop growing. And the biggest financial players in the world aren't preparing for collapse. They're preparing for dependency. And once you see what really happened, you can't unsee itself. Welcome to the wealth timeline, where money, power, and history quietly shape the world around us. Because what's happening now isn't a crisis yet. It's a transition. And by the time most people recognize it, the rules will have already changed. For most of modern history, government debt was treated as temporary. You borrowed during wartime, you paid it back during peace. Deficits were seen as failures of discipline, not features of the system. But starting in the 1970s, that logic quietly reversed. Governments began running persistent deficits, not because of emergencies, but as policy. Central banks began holding more sovereign bonds. Pension funds, insurance companies, and eventually asset managers began treating government debt not as risk, but as the foundation of safety. By the 2000s, U.S. Treasury bonds weren't just investments. They were the collateral backing the entire global financial system. At the time, this seemed reasonable. What no one noticed was the cost. The shift began in 1971 when the U.S. ended the gold standard. For the first time in history, the world's reserve currency was backed by nothing except trust in the issuing government. That government would need to manage inflation, control spending, and maintain credibility. But it also unlocked something unprecedented, the ability to issue debt without immediate consequence. In theory, floating currencies were supposed to create discipline through market signals. If a country overspent, its currency would weaken. Investors would demand higher yields. The correction would be automatic. In practice, the opposite happened. Because the U.S. dollar was the global reserve currency, demand for U.S. debt became structural. Foreign governments needed dollars for trade. Banks needed treasuries for liquidity. Pension funds needed them for regulatory capital. So even as U.S. debt grew, interest rates stayed low. The system had created a circular incentive. Borrow more because you can, and you can because others need you to. By the 1990s, this was no longer controversial. It was consensus. Economists called it the exorbitant privilege. What they didn't call it was temporary. It worked, but only under conditions that would not last. After the 2008 financial crisis, the system entered a new phase. Central banks didn't just lower interest rates, they began buying government debt directly, trillions of dollars worth. The Federal Reserve, the European Central Bank, the Bank of Japan, all became the largest holders of their own government's bonds. This was called quantitative easing. It was presented as an emergency measure. It never stopped. At the same time, asset managers like BlackRock and Vanguard grew into the largest holders of financial assets in history. Their index funds didn't pick winners. They bought everything, including massive positions in sovereign debt and the banks that financed it. This created a feedback loop. Governments issued debt. Central banks bought it. Asset managers held it. Banks used it as collateral. And because everyone was holding the same assets, any disruption to sovereign debt markets would hit everyone simultaneously. The system was deeply interconnected. That made it efficient. It also made it brittle. By 2020, central bank balance sheets had quadrupled. Corporate debt had reached all-time highs. Government deficits were normalized across developed economies. The stronger it became, the harder it was to stop. The first warning came in 2022. After decades of low inflation, prices surged. Central banks had no choice but to raise interest rates rapidly. For the first time in over a decade, borrowing became expensive, and the cracks appeared immediately. In March 2023, Silicon Valley Bank collapsed, not because of bad loans, but because rising rates had destroyed the value of its treasury holdings. Within days, 3 more banks failed. The financial system experienced its fastest bank run since the Great Depression. The UK pension system nearly imploded when a sudden spike in bond yields triggered margin calls worth billions. Even the US Treasury market, the most liquid market in the world, began showing signs of stress. In October 2023, trading volumes spiked and bid-ask spreads widened. Liquidity was vanishing. These weren't isolated events. They were symptoms of the same underlying problem. The system had been optimized for low rates and infinite liquidity. The moment those conditions changed, the entire structure became unstable. But here's what made it dangerous. Nothing collapsed, and that was the problem. Because the system didn't break, the solution became obvious. Don't let it break. In 2023, the Federal Reserve introduced the Bank Term Funding Program, a facility that allowed banks to borrow against their treasury holdings at face value, even though market prices had fallen. Translation: the Fed guaranteed that sovereign debt would always be worth what it was supposed to be, regardless of what the market said. The Bank of England intervened directly in the gilt market to prevent pension fund collapses. The European Central Bank restarted bond purchases to prevent a sovereign debt crisis in Italy. Each intervention worked. Stability returned. But each intervention also confirmed something critical. The system could no longer tolerate normal market discipline. Interest rates couldn't rise too high, or sovereign debt markets would seize. They couldn't stay too low, or inflation would spiral. Central banks were trapped between two unsustainable outcomes. And the biggest financial institutions in the world, BlackRock, Vanguard, JP Morgan, Goldman Sachs, understood this perfectly. They weren't terrified of collapse. They were terrified of transition. From this point on, the outcome was no longer optional. What happens when sovereign debt becomes too important to fail? Power centralizes. Governments can no longer afford to reduce deficits because the financial system depends on continuous debt issuance. Central banks can no longer afford to step back because markets require their intervention to function. Asset managers can no longer diversify away from sovereign risk because there's nowhere left to go. The result is a system where the largest institutions are functionally aligned with state power, not through conspiracy, but through incentive. BlackRock manages over $10 trillion and advises central banks on asset purchases. Vanguard holds trillions more in passive index funds that automatically buy government debt. The biggest banks are now required by regulation to hold sovereign bonds as their safest assets. This isn't corruption, it's structural dependency. And the cost is being absorbed quietly, through inflation, through currency devaluation, through financial repression that keeps real interest rates below inflation. Savers lose purchasing power. Wage growth lags asset growth. Wealth concentrates toward those who hold financial assets, which are overwhelmingly held by institutions in the top 10%. The system stabilized. But it didn't return to normal. This isn't a prediction. It's a pattern. In the 1920s, war debt became unsustainable. Governments tried austerity. The result was deflation, mass unemployment, and political extremism. In the 1970s, governments tried stimulus without discipline. The result was stagflation and a decade of instability. Today, governments are trying a third path: perpetual debt issuance backstopped by central banks and held by institutions too large to fail. History doesn't tell us how this ends. But it does tell us what happens when financial systems become inseparable from state power. They don't collapse cleanly, they transition. History doesn't repeat events, it repeats incentives. Here's what this means. First, when a system is too interconnected to fail, failure doesn't disappear, it becomes distributed. Everyone absorbs a small permanent cost instead of one institution absorbing a catastrophic loss. Second, the institutions that understand this earliest position themselves accordingly. They don't fight the system. They become essential to it. Because in the world of wealth and power, history never ends. It just changes hands. If you enjoyed uncovering this hidden chapter of history, make sure to like this video, subscribe to the Wealth Timeline, and turn on the bell icon. Because the next story might just change how you see power itself.